Okay, let's go over this chart review. It's really a trend review that I do. Okay, we're going to start from here. Now, here's what this is: the Dow 1000 tick YM futures contract. So now observe what's going on here. You know, you have rallies, so on and so forth, blah blah blah, and then you have all this climax. Now understand what happened here. This is what's important. Okay? This here is what's important. That's 7,700 contracts traded in this upwave. 7,700. Okay, someone's accumulating a lot of contracts. Why? You can see that this wave is bigger than all the other buying waves. I think they may have accumulated up here, I'm not sure, but here definitely something's going on. As price is going down, take a look at the red waves, you see it increases here, right? So this is some type of climactic action. You know, price is moving down here, down, 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 and on the lowest wave there's very heavy volume, and it is followed by the biggest up wave in 1, 2, 3, 4, 5, 6, 7, 8, more than 8 waves. So what is this? Well, right now we don't know, but we know that demand has come in with 7,700 contracts. And the pullback, let's just think of it in terms of supply and demand. Demand 7,700 contracts, supply 1,200 contracts. The ratio here is over 6 to 1. Right? So, right here, this becomes very interesting. You have demand on 77, supply on 12. Now let's think in terms of strength and weakness. You can say that at this point, demand is strong and supply is weak. And graphically, look at this. All this green and this little red. So when you compare the two, who's strong? Demand. Even from the high climax, after this much demand, who's stronger? Demand. Is it supply? No. Demand is bigger than supply. And the ratios actually makes it very obvious. Now, strength in demand, weakness in supply, and follow through strength in demand in the form of a big range thrust. Keep this in mind. Strength in demand, weakness in supply, and a follow-through thrust, meaning it's just another expression of more strength in demand. So demand is strong, supply is weak, demand is strong. Okay? This is what caused the change in direction and a demand bias, meaning basically it means that direction is more likely to go up in the direction of demand than it is likely to go down in the direction of supply, because demand is overwhelmingly stronger than supply, and it has proved itself with a like 6 to 1 ratio, and has follow through. Okay? Then it goes up on even more. 84 demand. What's the supply? 15. Still, who's in control? Obviously demand. Then it has a follow through up wave. So this is showing you that demand is strong, and just compare demand to supply. Then demand again to supply. Who's stronger again? Demand, no supply. Demand, no supply. Or demand, little supply. Demand, little supply. Obviously demand. Then you have fall through up wave, and then you have this spring. Okay? That's very important to frame this action. So you can see the spring and you can see what's going on. After this, what you had was a spring where what they did, they just basically took out all the folks here, right? And then you had a rally and it went sideways. What is this sideways action in terms of behavior? When you read Wyckoff, figure out what this is, because it's near a prior high. It is absorption. It is absorption. Absorption is occurring right here, and after that you have, at this point where the absorption is occurring, the market is on what you call a springboard. Market is on a springboard right here, and then you have that green bar, which is breakout. I think it's also a markup bar, meaning it's going to continue to mark up. So you have this breakout here, breakout of the absorption area, and then you have another breakout of the range. So now you have a pullback on 25, and again you have 63 up and 13 down. Now pay attention to this because this is important. Again, you have 63 up and 13 down. Now who's stronger, supply and demand, or demand? Obviously demand is exerting strength, but is there any follow through? What is the difference between the action in the background and the action up here? Well, first of all, it is the position in the trend. This is coming after, after the market is going down. Right? The market is going down, so they're buying low, right? That's the first thing. Over here, someone is buying high. Okay, there's a difference when the market is going in a downtrend or flattening out or is in a pullback. You want to buy at lower prices. It's typically the CM. But up here, after multiple waves up, it's more questionable about who's buying, because this is that's one difference. The second difference is what? There's no thrust. There's no big range. There's no follow through. There's no thrust, no big range, no follow through. Then that third component is not there. You have one, big demand, weakness in supply, then follow through demand. The three components are there. Here you have big demand, weakness in supply, and no third component, the thrust. In addition to, market nearing a top. And you also want to, you can do all that, but remember, you want to keep in mind the background. There's all of this that you have to fight. Okay, that price would have to go through. So even if there's demand here, pullback, low volume pullback, and then it's going up, it has to get through this brick wall, and that's not going to be easy. Not at all. And this is where supply comes in. Supply comes in, and now we want to look for the same three components, and we find one component, meaning strength in demand. Find the second component, strength in supply, weakness in demand. You could tell by the ratio of 76 to 12. 76 is supply. Obviously you have big supply. 12 demand. Take a look at this. That's not good demand. It's bad demand, right? Poor demand. But is that third component there? Meaning the thrust or the big range or evidence of follow through or anything like that? No, it's not. Which means you're in the same predicament as you were up here. This predicament is the same as this predicament, where you have good demand, or what's perceived to be demand, low supply, but the market doesn't have that third follow through demand in the form of a thrust or a big up wave. Similarly, supply has good supply, poor demand, but lack of follow-through supply in the form of a big thrust or a follow-through wave. Here you had it, here you didn't, and here you didn't. So now watch. Price again comes up. Look at all this demand that comes in. Greater than 1, 2, 3, 4, 1, 2, 3, 4 prior up waves, and greater than the supply from this area. Remember, the position is equally important. Smart money will not buy highs within that trend. Okay, but here you're in a position of a pullback or contraction. Okay, so it's different. You're in a position where they I guess it's more psychological. They're buying low or at a discount or something like that. Now that's here, you see again that there's demand. You have demand. Is this supply here? No. You have two components of demand and supply. Big demand, no supply. The key is the follow through. Bang! Follow through demand. See that? You cannot just have big demand and small supply. It's not enough. As the case showed here, as was shown over here. But this case is different because you have demand, you have weak supply, and you have follow through demand. You have follow through demand. All the three components are there. Strong demand, weak supply, follow through demand in the form of a thrust or a strong wave. There is the other component, which is your position in the trend, that also has to be there. It has to come from contraction, and you have that because you have a pullback, or you have like towards a bottom. So in the form of contraction or what is perceived to be a low, as the price is going down. So this is important because trend position, in my opinion, will identify who's buying. If you have high volume at the bottom, right, it is more likely it could be short covering, but it could also be accumulation. If you have high volume at the top of a trend, the smart money is not dumb. They're not going to buy high prices. The public is getting it at high prices. Smart money will always buy because it's just smart to buy cheaper than more expensive. So this pullback set up the buying. Someone bought here, got good prices because it's not above here, it's down here, and they bought it. Now the selling pressure comes in, it's nothing there, and now you have the thrust, the follow through demand, the third component. All four components are there. Big demand, weak supply, follow through demand, and the position within the trend near a low, near sideways, contraction, or a pullback. All of that is there. So you have an edge there. And what they did was very slick. Like, even if you get in, right, be very careful about where you place your stop, because that's what they're going to do. After this thrust, they're going to test, and the ultimate test is a spring. Why? Because it's not just a test, it's actually a shakeout, or basically they're going to run stops, forcing whoever bought into this to sell. As they sell, smart money will buy. That's why this bar has a high-end close, because when it came down to this level, hit the stops, forcing longs to liquidate and sell their positions, while the other side buys what the public is selling. Okay, so that's why the high-end close came. It went right below the low, bought everything, and then made a new high. relatively speaking, in terms of trend. So this is real tape reading, not other stuff. Um, that this is what you're trying to do. This is the essence of Wyckoff. He obviously he didn't have these indicators, but this is what he tried to do. He always tried to judge supply and demand. In fact, that is tape reading. It doesn't matter if you do it on a depth of market, level 2, a Renko chart with volume, which I've seen, point and figure with volume, which I've also seen, which was the original tape reading chart. It was created by Wyckoff, which was a point and figure with volume instead of X's and O's. Yeah, all that doesn't matter. These are just mediums. On these mediums, you will have data, and that data will have buy and sell, supply and demand and supply. And being able to gauge that is the ability, is really what tape reading is. Well, it doesn't matter if it's on a chart or whatever. It really doesn't. Okay, so that's what's going on here. Now this market is live. I don't know what they're doing here, but it looks like absorption. I really don't have enough bars here. This is the range now, and I'm just watching this block. I'll just wait till tomorrow, but this is what's going on here. And this is how you basically judge supply and demand. Now, can this be done with regular volume? Not on a tick chart, but I believe it can be done on time-based charts. With regular volume, I think so. It can also, in my opinion, be done by bar counts. You can, to some degree, do it based on bar counts, which works fairly well on bar charts. But anyway, who cares? The point is, are you able to judge supply and demand? Because I've seen this enough to understand that direction most of the time is the result of strength in one side, weakness in the other side, and follow through strength in the first side. Meaning strength in demand, weakness in supply, with follow through strength in demand will create a directional bias to the upside. Similarly, strength in supply, weakness in demand, and follow through strength in supply will create a directional bias in that moment to the downside. Okay? Now, other things to note is, obviously it's not as simple as watching 2 or 3 numbers. So you have to know the levels, whether you're at a support or resistance level on a higher time frame. That's very important because there are orders there. 2, you have to see where this strength and weakness is coming. Is it coming near the top of a trend that's already going up? Or is it coming after the market pulls back and starts moving sideways? Or is it coming as the market goes down and it's moving sideways? Is it coming there? Then it could be a counter trend up, or it could be a minor rally, like one of those conditions. But the point is, you have to know the background, you have to know the higher time frame, and you have to know the position within the trend of both your current chart as well as the higher time frame. And all of that needs to be coordinated together to have like an idea. And even after that, it's still, this is just an edge. It doesn't mean the market has to continue higher. It may just be momentary. It may just be 1 or 2 bars or 3 bars, and then what happens is, like out of nowhere supply can come in. So all of these things comes, but as far as the tape reader is concerned, this is definitely a directional edge. Alright, that's all. Thank you.